Hi Jay, welcome back. Continuing our series with how to protect our old investments and continuing to invest and protect our new investments also. Um, I wanted to look at Amazon because Amazon has got taken quite a beating this past month, especially after earnings. But I still feel there is a lot of value in Amazon. So I wanted to see what my options are if I wanted to purchase the stock and at the same time want to protect the investment.
Sure, Ramya. I think I'm sure you would have heard of the strategy called as collar strategy. One of the most popular one used by hedge funds when they have huge amount of stocks and they kind of protect it on both ends. And this is protected. This is you are kind of capping your upside, but you are kind of making that fund for your downside protection. It's basically sell call, which will typically fund your buy put.
Okay.
So we will probably simulate that and see that is called as a collar strategy. You own 100 stocks of Amazon or you buy 100 stocks of Amazon because it has taken a lot of beating in the recent days. And then you simultaneously sell a covered call on that, capping your upside,
Right.
whatever is your desired
Design.
percentage profits, and buy a put which is funded by the sell call, which lets you protect your downside. Beyond this point, if Amazon goes down, you always have the right to sell the stocks that you purchased. So that is the buy put which you are adding to your stocks. So we will probably look at that in our simulator. So I have taken Amazon and I'm going to add 100 stocks of Amazon, right? So this is added. So right now, if you add 100 stocks of Amazon, you will add it at the price of 198.96, so 19,896. So when you do a collar, what you typically would do is you do a sell to open. Let's say how far you're okay to go. May is okay,
Yeah, sure. Amazon.
May, and then what would be the price that you're okay for these stocks to be called away?
I mean, reasonably 6 months. So typically in a year, I look for 20%. So 6 months, maybe 10%. So about 220.
Okay. So by May 2020, that is giving you a credit of around 750. So using this credit, I will do a buy put for May. Let's say I will probably look for something which is similar to, yeah, 180
Right.
is even, in fact, it is giving you more credit, or even 185. 180 is better, 185.
Okay.
Okay. So if it goes below 180, so you need to spend $680 to buy this put.
Mhm.
Basically, you have the right to sell Amazon stocks at 180 if it goes below 180. So that is the one that it does. So as you can see this together, this is how it will look. So if it goes up, it actually caps your profit at 2,164. And as you can see, your downside is protected. The max loss from this by May 2026 is 1,836, and you can gain around 2164. See, and see if you want to just hold on to the stocks, and let's say that the stock goes to 180 by April. This
Mhm.
is the loss that you will incur. It's 1,091. You can just close this together, or you can just close these two legs or roll these two legs to a
Right.
later date and still maintain your call position by booking this profit. You're still owning 100 stocks. You can just play around with this. As you can see, if it has come down to 180, both of these would have gained value.
Right.
Both the sell call as well as the buy put would have gained value when it has come down to 180. So you can just close this or roll this to a later date and maintain, or sell everything together
Right.
by
Okay.
booking this much of loss. Or let's say if it goes to 200 by 470, you're actually still having some profit. I mean, the stock has really gone up because you have this put and call. You're only this much of profit. But if it is going to, let's say, 220 by this date, put together you can close all of these positions and book this profit of 1270. So you can decide based on how your outlook is and what is your need for maintaining this particular stock, and then take an action on this. So this is a beautiful strategy where you are protected on your downside, which is being funded by entering a covered call, which is actually technically capping your upside on the stock.
Stock. All right. Yeah,
Yes.
definitely something I have to look into, the collar strategy to protect my old positions as well as upcoming positions.
True. Reason is, if you have old positions, you can enter a call. It's not necessary that you have to add the stocks and then enter a column. You can even make it a column for your stocks that you already own. If you feel that no, you have a need to protect that from a big downside, then people place collar on your old positions as well.
All right. Thank you, Jay, and we'll keep continuing our discussion.
Thank you.